Understanding the accounting equation, definition and calculation. Have you ever wondered how accountants always make sure the books balance? Behind every balance sheet and every financial report, there is one simple formula holding everything together. It's called accounting equation. It's called the accounting equation. Accounting equation is the basic foundation of all accounting. It states that a company's assets must always equal its liabilities plus its owner's equity. Now that might look as technical, but it's actually very easy to understand. Assets are everything the business owns, such as cash, equipment, inventory, building, money in the bank, and liabilities are everything the business owes. Loans, unpaid bills, debts, and obligations. Owner's equities, owners share in the business after debts are taken away. In simple terms, it's what truly belongs to the owner. So this equation is basically saying everything the business owns was paid for by either borrowing money or the owner investing money. Let's make this simple with numbers. Imagine a business has 50,000 in assets. Out of that, it owes to 20,000 in loans and unpaid bills. The remaining 30,000 belongs to the owner. That means the question balances perfectly. 50,000 equals 20,000 plus 30,000. Okay, now that makes sense. The balance must always stay true after every transaction. For example, if a business takes out a new 10,000 loan, cash increases by 10,000, but liabilities also increase by 10,000, still balanced. If the owner adds 5,000 of personal money, the assets increase and owner's equity increases by the same amount, again balanced. This is why accountants love this equation. Every single transaction can be checked against it. Now, why is it so important? Because it creates structure for the entire balance sheet. Without this equation, there would be no organized way to understand what a business owes, and actually has left. To help catch errors, if the equation doesn't balance, something has been recorded incorrectly. A common misunderstanding is thinking this is just a common misunderstanding is thinking this is just a school formula. It's not. The question is actively sitting underneath real company accounts each and every single day. Another misconception is that it only matters for big businesses. In reality, even the smallest companies' financial follow this exact same logic. So what's the key takeaway? The accounting equation is the foundation of accounting. Assets always equal liabilities plus owner's equity. My apologies. It keeps every financial transaction balanced and gives businesses a clear picture of their financial position. And once you understand this formula, a huge part of accounting suddenly becomes much more. Let me try that again. And once you understand this one formula, a huge part of accounting suddenly starts to make much more sense. Thanks for watching.